In the last segment, we have discussed how security managers can allocate and justify a security budget with the help of investment models. In this segment, we will broaden the perspective to general information security risk management. Setting money aside for controls, even if we know how much and exactly what an organization needs, is not the only way of dealing with information security risks. You might recall the 4 canonical instruments in general risk management: risk reduction or mitigation, risk acceptance, risk avoidance, and risk transfer. Each of them has a specific meaning in risk management, which equally applies to the management of cyber risks. Successful security investment corresponds to risk mitigation, the first instrument. Risk mitigation tries to reduce the likelihood and severity of loss events by protecting vulnerable assets with technical and organizational measures. But recall from the last segment that an optimal level of information security investment does not mitigate the risk completely, because at some point, the additional cost of more protection exceeds the expected losses without that protection. As a result, there remains residual risk to be managed. This leads us to risk acceptance, the second instrument. Risk acceptance means that an organization chooses to tolerate losses. This is mainly the case if no other risk management instrument is economical. Allow me 3 remarks on risk acceptance. First, this decision should be documented ex ante, which means before the risk materializes. Otherwise, it is hard to convince managers and shareholders suffering losses that risks were intentionally accepted rather than overseen or ignored. Second, keep in mind that some risks must not be accepted. For example, data protection regulation in many countries requires security controls for organizations that process personal data. Risk acceptance would break the law even if no breach occurs. Third, the propensity to accept information security risk must depend on the organization's overall risk profile. Don't confuse this risk profile with a natural person's attitude towards risk, a behavioral feature which we will discuss in the last block of this course. I specifically mean the riskiness of the core business, which sets bounds to acceptable information security risks. Here is an example. Consider 2 firms, an established multinational brand and a tech startup. In the language of finance, the startup is nothing else than an option to default. With more than 50% probability, it will not survive the next year because the technology may not work out as intended, a competitor might be faster on the market, or for missing demand. In such an environment, it would be foolish to invest money to reduce the likelihood of a catastrophic security breach from, say, 5% to 1%. By contrast, the multinational brands look at a much longer time horizon and has more valuable assets to lose, including its reputation. If a catastrophic incident could wipe out the shareholders' profits for years, a rational choice may be to spend money, even more than proportional, on reducing the very same kind of risk that the startup rightly chooses to accept. If our imaginary multinational brand can neither accept nor sufficiently reduce a specific risk, say for lack of efficient protection technology, it may take a more radical approach and avoid the risk altogether. Risk avoidance, the third canonical instrument, always implies that the organization withdraws from a risky business. For example, it could limit daily transaction amounts in the online channel or stop doing business with or in a risky country. The cost of risk avoidance is equal to the foregone profits from the risky business. The last instrument is risk transfer. It involves a contractual agreement with a third party to compensate the organization for losses incurred due to the realization of risk. The third party can be an insurance company who pools risks of many policyholders and counts on the law of large numbers to hope that not all risks will materialize at the same time. Other constructions are possible too, including risk-linked financial instruments traded on markets, but such tools are still premature for cyber risk. Even cyber insurance is not as big a success story as many had hoped. In the early days of security economics, scholars and practitioners were enthusiastic about cyber insurance. They thought that premium differentiation, that means charging insecure systems more than secure systems, would provide incentives to security demanders to secure their networks better. Also, providers would add more security to their products as this decreases their customers' total cost of ownership, which they assumed would include insurance premiums. Others envisioned a larger role of the insurance industry in loss research, using its wealth of claims data, and facilitating the development of appropriate security technology and standards. However, even conservative forecasts of the cyber insurance market have been undercut by orders of magnitude. A thin market is starting to develop in niches created by market friction, domain-specific regulations such as breach disclosure laws, or pronounced risk aversion. What makes cyber insurance difficult? Early answers to this question pointed to the lack of historical data needed to calculate competitive premiums. They complained about missing demand because senior managers were apparently not aware of their exposure to cyber risk. Legal uncertainties surrounding attribution and substantiation of claims were also mentioned. This is all true to a certain extent, but it cannot be the whole story. Today, we look back at a decade of breach disclosure data. We see that digital forensics has matured as a discipline to reconstruct successions of events, and the literature, as well as the number of experts in information law, has skyrocketed. It is also notable that insurers had no issue with insuring early satellite launches where no historical data was available either. What makes cyber risk difficult to handle at large are three distinctive features: information asymmetries, externalities, and correlated risk. Ross has introduced information asymmetries at the beginning of this course. Asymmetric information impairs insurance markets if insurers cannot observe the actual security level of their policyholders. This means they are unable to tell good risks from bad, with the effect that premium-based differentiation cannot be enforced. Fixed premiums are either too high for good risks, so they do not join the pool, or too low for bad risks, in which case the insurer is likely to go bankrupt. Externalities cause market failures in many parts of the cybersecurity ecosystem. Tyler is going to explain this effect at length later in the next block of this course. So let me elaborate on correlated risk, which is a specific problem for insurance and risk management at large. The whole idea of insurance is to trade an uncertain payment in the future, the potential loss, against a certain payment now, the premium. Insurance markets exist if insurers can make such offers. They act as financial intermediaries and redistribute the premiums of policyholders who did not experience any loss to the few who demand compensation. This works if you insure a large pool of risks with occasional incidents. Let's treat this a bit more formally. Assume we have n homogeneous firms who each independently face a fixed loss lambda with probability p. Then this here is the important distribution for an insurer who underwrites policies with all these firms. The chart shows the probability density of the total claim amount per period. We can summarize this distribution by its expected value. This gives us some guidance for the premium calculation. But hold on a second. If the insurer charges a net premium at the expected value divided by the number of policyholders n, he'd be bankrupt every second period. This is because the actual losses fluctuate around the expected value, so they can be lower or higher. To the extent of this fluctuation, in other words, the variance of the distribution, depends on the size of the pool. The more risks an insurer underwrites, the more predictable is the total claim amount. Nevertheless, even insurers with very large pools need to add a markup to the premium to reduce the probability of bankruptcy from 50% to a very low level, say 1 in 1,000 periods. This headroom is called safety capital, and the markup is used to finance it. So far, our model assumes independent sources of risk. However, cyber risk has often a common component called systemic risk in the language of finance. For example, a vulnerability discovered in standard software exposes all systems running the same software at the same time. To model this, we add a common factor to our risk arrival model. We introduce a new parameter rho to control which fraction of risk is caused by the common factor, the systemic component. The remaining risk is said to be idiosyncratic. Using some algebra in the background, we keep the expected probability of loss P fixed as we increase the amount of correlation rho. See what happens to the shape of the total claims distribution. Larger and potentially catastrophic losses become more likely than with independent risk. This in turn forces the insurer to increase their safety capital by raising the markup. The premium gets more and more expensive until it exceeds the policyholder's willingness to pay. This is why correlated risk is hard to insure. Although it is difficult to quantify the amount of correlation exactly, there is quite some evidence that cyber risk is often correlated. Making cyber risk insurable therefore means tackling the root cause of correlation, for example, by building and deploying more heterogeneous systems. In that case, newly discovered vulnerabilities do not become a common risk factor anymore. Another option is to limit interconnections in order to cut the propagation of risk in a network. To conclude, let me put all this in a bigger picture. Recall from Ross's segment that the properties of information goods, and software in particular, have unleashed surprising economies of scale. Those are the software industry's secret of success. They have been and will remain a major incentive to innovate in software and in information goods and services generally. The flip side includes both monopolies for organizations and, as we've seen in this segment, monocultures of network components, which are the root cause of correlated cyber risk. If we envision a future with more information infrastructures, insuring them at affordable prices would come at a cost, forgoing some of the economies of scale in order to make cyber risk more manageable. In a globalized and interconnected world, this decision is not in the hands of any individual manager. Instead, it would require coordinated action by policymakers around the globe.